There are a couple of other points that I'll make just very quickly in order to sort of get them on the table. One is the question of how do we actually regulate better? I don't think there's anybody who would disagree with the notion that we need regulation. Sometimes the argument is whether or not we should have more regulation or less regulation. The issue is not, I think, that. The issue has always been and continues to be, how do you have good regulation? We have to have regulation. And I don't think anyone can truly debate that general issue, even in this room. So what we end up with is the question then of, if you're going to have regulation, if there are going to be market failures and you need a governmental institution and governmental entities in order to be able to address those market failures, how do you do it best? What are the answers for that? We unfortunately have a regulatory structure in financial services that has not been changed in any kind of dramatic fashion or even in any kind of material fashion since we basically put it in place in some parts long before the Depression and certainly in material and significant part right after the Depression. Those changes that are needed are pretty apparent. For one thing, we have institutions that are regulated as entities as if it's the institution that's the problem. Let's look again, though, at the too big to fail question that's come up. And Jamie Dimon had his Washington Post article about specific bank holding companies being too big to fail. What we have seen, and we can go back in history to, for example, the failure of long-term capital, the idea of too big to fail isn't necessarily whether or not it's a regulated institution that is too big to fail. It's whether or not whatever entity might be failing is going to have some kind of systemic risk or potential to have the dominoes falling in other areas of the economy, and whether or not you need, therefore, to prop it up or do something with respect to it. Long-term capital was not a bank holding company. It was not a bank. It was not a thrift. It was not a credit union. It wasn't even a broker-dealer. It was basically a hedge fund, and it by itself had accumulated enough potential obligations and liabilities that the view was, were it to fail, it would have some potential systemic risk throughout the entire economy. Here, we have a different issue. If you look at the idea of millions of individual homeowners who all bought into the same idea at the same time and were given the same credit terms all at the same time by an industry that was very heterogeneous at the time in terms of an awful lot of individual small banks and medium-sized banks and others who were issuing mortgages through their subprime mortgage originators and then securitizing them and then reselling them. If you look at that, what you end up with is the idea that, again, you have sort of, if you will, too big to fail coming from a whole series of millions of individual homeowners. You can't simply look at too big to fail as a question of size. It's a question of what's the impact on the economy as a whole. And so if we're going to have regulation that talks about how we reduce and evaporate, if we can, the risk of too big to fail, we need to rethink the regulatory apparatus and rethink the regulatory structure. Some of what is currently on the table is interesting. For example, there is a question about having a consumer financial protection agency. I think many people at this point dislike it. A lot of the banking industry dislikes it. But it's actually interesting if you look at it from two different perspectives. One is the notion that there were a lot of homeowners that at the end of the day didn't understand what they were signing on to, didn't understand how adjustable rate mortgages were working, didn't understand the notion of what would happen if, in fact, they couldn't make payments, et cetera, and didn't understand that nobody was looking out to see whether or not, in fact, their home was able to be eligible for other kinds of guarantees down the road, et cetera. There's a different way to look at that agency, though, or that proposed agency, and that's to try to eliminate one reason that we have the current crisis, one idea of how you generate systemic risk, which is, had there been somebody sitting there saying to an awful lot of these homeowners, if you had the ability to stop millions of homeowners at that time, which raises another public policy question, from getting subprime mortgages, would you have, therefore, stopped this debacle from starting to roll downhill to begin with? And in fact, you could look at the current ideas of the CFPA not necessarily as consumer protection, but as systemic protection, and as a means to be able to eliminate part of the cause that creates too big to fail. Because the too big isn't necessarily just a single institution, it's the interconnectedness of a lot of people all acting in the same way. So I think we really need to rethink how we look at regulation and how we look at some of the underlying concepts that create economic failures and economic bubbles in this country. I think, unfortunately, we're not there. We have a tendency, especially as lawyers, to think about things in an evolutionary process, building on the common law, looking at how things have come before, and then making tweaks and understanding what we should reason into the future from where we reasoned in the past. The problem is that we have changed so much. This is way, way beyond the days of Adam Smith. We're way into a different worldview at this point. We have to change, I think, in some radical ways, some of the thinking with regard to economic and financial institutions regulation, and I think that's the real task that we have in front of us. Let me stop there.
Thank you. Now, I know that you would like to ask questions, and the room has been set up in order to allow you to do that. So those of you who would like to ask questions of our panelists can make your way to the microphones, and we can start that process. And while you're doing that, it seems to me that our panelists kind of all agreed that we needed some kind of investigation. We needed to find out what happened. I personally would like to ask them to sort of look into the entrails and give me just one thing very quickly that the government should do or not do. And I'll start with Ambassador Gray.
Well, just one word about the TARP, and it's something the government should not do. While the TARP itself, I don't know enough about whether you can say it's a success or not. I don't think it's constitutional. I have a lot of other problems with it. But John Taylor has done some very interesting work at Stanford, which says that the effort, the blackmail to get the TARP enacted did far more harm to the economy, the world economy, as well as our own, by scaring the bejesus out of people. And in order to get it passed, it did far more harm than it possibly could have alleviated. And I think that needs to be studied. I don't think the government should go around telling everybody that their toilets are going to stop flushing, the light's going to go out, and their heating's going to turn off on Thursday if you don't pass this thing by Monday. I mean, I just don't think the government should do that kind of thing. And I don't think, I mean, John Taylor's work suggests, and he's the economist, not me, that the world would not have come to an end if they had taken a little more time to work through the details. Another example of what the government should not do without knowing what they're doing is now the plan to create a $3 trillion new commodities market for people to play with, and with derivatives and credit default swaps and whatnot. This is the carbon market. My favorite provision of Kerry Boxer is a section that calls for the creation of a carbon oversight board, the purpose of which is, quote, to reduce systemic risk. And I say to myself, reduce it, why not eliminate it? Or I ask myself, why create it to begin with? I mean, what are we doing here? And Senator Gillibrand has written a lovely op-ed 2 weeks ago in the Wall Street Journal saying that the way Wall Street's going to come back is with the enactment of this carbon market, and therefore we should merge the creation of this carbon market with financial regulatory reform. Well, I don't think we need to create the carbon market. I mean, cap and trade is great, but you don't have to auction off $3 trillion in allowances in order to have cap and trade. So let's not do the $3 trillion commodities market.
Okay. I do want to get to some questions, so we'll just try to work this in, and the panelists who haven't gotten a chance to talk about what the one thing they think needs to be done can perhaps work that in as we go through some of the questions. So I'll start with this gentleman here.
Well, I'm a simple-minded fellow, and I can only see the text of the Constitution that's actually printed. I'm unable to see all the emanations and penumbras others tell me are there. We also heard the panel earlier today that it may be appropriate to interpret the Constitution more narrowly when it comes to the powers of the federal government, and perhaps more broadly when it comes to protections from those powers. With all that, I have a hard time seeing where the constitutional authority lies for the federal government to take taxpayer money, invest it in some corporations but not in others, to intervene in bankruptcies, to modify the rights of some creditors but not of others, and to intervene in employment contracts of private citizens and modify some of them but not others. I'd like to get the panel's views on where you believe that constitutional authority lies and how solid you think it is.
Well, there are only 2 lawyers here, so I guess Mr. Wallman, that's...
I'll defer to the ambassador first, though.
Oh.